Before we get into the new updates, just a quick reminder, the original Secure Act was passed, I think, the end of 2019, and they went into effect in 2020. Some of the most notable things in the Secure Act was it raised the age of required distributions to age 72. So required distributions, again, are the money you have in your 401k, IRA, SEP IRA, whatever it might be, that is not Roth. At age 72, whether you need the money or not, you have to start taking distributions, and you're taxed on the amounts that come out according to IRS rules. It used to be age 70 and a half. Then in 2019, they raised that required age to 72. It changed again, I'll cover in a minute. And then the Secure Act in 2019 also introduced a 10-year distribution period for inherited IRAs. So if you inherit, and it's not your spouse that you inherit it from, generally you've got a 10-year window to get the money out. And there's some ambiguity around exactly what the rule is, and you know that hopefully was going to be cleared up, and we'll discuss that in a minute. If you have inherited an IRA from, say, your parents, it's probably good. Make sure we're aware of it. We can help you through the distribution. There's a lot actually that goes on, believe it or not, particularly if it's of any size, just to try to manage the tax impact. And there's some planning strategies we can do around that we've done for probably a number of you on the call, but please let us know that, because that's important. All right, so the new Secure Act 2.0, signed into law December 29th. That's why not a lot of people even realize, because everyone's busy with their holiday gatherings and turkey and New Year's. And so it kind of went through. There's a little blip on the news about it, but it does have a few pretty major impacts that we're going to discuss. The first one is it does change that required distribution age. So instead of 72, starting in 2023, that required age is 73. Okay. What it means is if you've already started required distributions, nothing changes for you, because you were 72 last year and now you're 73. There's no change. But really just projecting forward, people who are younger than that age, that is your starting point now. In addition, they also forecasted another increase in that age to age 75. So the way it works is, if you are currently taking distributions, there's no impact to you, as I said. If you were born between 1951 and 1959, your required minimum age is age 73. If you were born 1960 or later, your required minimum age is age 75. Okay? So that's just, it was actually written in a much more difficult way to understand. So thanks to Steve for putting that together. That's a whole lot easier to understand when you link it to the birth date. So important things. We're running into this constantly, where people save substantial amounts of money into their retirement account while they work. And then they maybe don't need to take that money for a period of time in retirement. They either have other sources of income, or they work longer than they expect, et cetera. And now they're taking huge distributions at their required minimum distribution age. I really encourage you, for those of you that are clients, we're working through this based upon your age. If you're not a client, I encourage you really need to go through some thoughtful tax planning on how that's going to impact you, because you might be surprised at the impact it will have, particularly on your taxes. One of the easy things to do is consider doing some Roth conversions strategically in certain years, low income years, et cetera. That's a whole nother conversation that we can have a different day. All right, some other highlights of the Secure 2.0 Act. This is unique and interesting. So now the employer matching contributions in your 401k. So you have a traditional 401k, you also have the ability to do a Roth 401k. But up until now, regardless of which one you contributed into, if your employer matches your contributions, that always went into the traditional 401k. There were always pre-tax dollars. Now, starting this year, it's possible, if your employer permits this and changes their plan, that the matching contributions that they do can also be Roth. So if you're contributing to the Roth and you want your matching contributions to be Roth, the Secure Act now allows that can happen. In actuality, what's probably going to happen is it's going to take a little time for administrators and employers to build out the mechanisms to be able to do that and allow it, but it is live today. So feel free to ask your employer about that if that's something you want to do. Another unique change in the Secure Act is that starting next year in 2024, if you are making catch-up contributions, so you're 50 or older, and you earn more than 100, if your salary or earnings from that employer is more than $145,000, your catch-up contributions must be Roth contributions. That's a change. So your catch-up contributions have to be after-tax contributions. Another change, student loan payments can be treated as elected deferrals. What that means is if, let's say, a younger worker who is making student loan payments, there's a mechanism for that to be qualified as an elective deferral, meaning that the employer can match into the 401k based upon student loan payments. And then there are additional catch-up contributions built in for ages 60 to 63, but that doesn't start for a few years, okay? And at the time, we can cover all that. But there's some added catch-up contributions allowed. All right, next. What is also notable were some things that were not in the Secure Act 2.0. So most of you may or may not be familiar with a concept that we call the backdoor Roth. All that simply means is a high income earner who is unable to contribute to a Roth IRA because they have too much income. There's a way to actually make a non-deductible contribution to a traditional IRA and immediately convert that to a Roth. And we do that for a lot of you. There was a lot of speculation because, again, that's kind of a circumvent around the rule to allow a high income earner to be able to get money into a Roth IRA. And so a lot of people figured that with the new legislation, they'd finally cut that out because when it was an unintended circumvention of the rule. It wasn't cut out. And so what it does is it kind of validates that absolutely is a strategy. And it also leads me to believe that, I don't know, they may become more lenient on the income caps in the future. Who really knows? They also, in the Secure Act 2.0, did not limit who can make Roth conversions, okay? Which, that's an important distinction. Previously, there was a cap on income to be able to do a Roth conversion. They removed that, and that has stayed. So now anybody, regardless of income, can do a Roth conversion. They also did not eliminate what's called the Mega Roth 401k. And I won't go into what that actually is, but basically it's a way for people to put a lot of money into their Roth 401k using after-tax contributions above the elected deferral amount and then do an immediate conversion to a Roth. I thought that was interesting, actually, because there was a lot of scuttlebutt about that probably being disallowed, but it wasn't. And then, unfortunately, they did not clarify some of the ambiguity around the 10-year distribution rule for IRA beneficiaries. And I'm not going to go into what the ambiguity is. Just understand, again, if you're in that situation, we can talk about it and I'll explain it. But that was not clarified either. Now, this has gotten a little bit of publicity, and you may have heard of it. This, I think, I had not heard that this was even something on the table, and it just popped out of thin air, in my opinion. But starting in 2024, there's an allowance now to be able to move 529 contributions and monies, essentially transferring, rolling them into a Roth IRA. So here's what we know about how that works. Now, there's some unknowns still, but here's how it has to work. If you have 529 money, it must be moved directly from a 529 to a Roth IRA. The receiving Roth IRA has to be in the name of the 529 beneficiary. So, example, let's say your son, my son, Carter. We have a 529 for Carter. Let's say he doesn't go to college or goes to the military or gets a full ride or whatever it might be, and there's leftover money in his 529 plan. This now allows 529 funds to be rolled over to a Roth IRA for Carter. So it has to be in the name of the beneficiary. That beneficiary must have compensation. So, and it falls under the Roth contribution rules. So in other words, the effect that they're trying to have is allowing you money that may have not have been used and kind of stuck, for lack of a better word, in your 529 plan for your kid, using that to fund a Roth IRA in their name. That's the intent behind it. The 529 plan has to have been maintained for 15 years or longer. That's a unique rule. They're trying to prevent kind of the backdoor Roth strategy where you just contribute to a 529 and move it. Got to be in there for 15 years. And any contributions and the earnings attributable to those contributions within the last 5 years, they're ineligible. All right. Now, one of the questions that has come up, and this is where we don't know yet. Again, I think over time we'll get some clarity. Many people are aware that you can change the beneficiary of a 529 plan as long as it's within the same family, right? So my son Carter, I could change the beneficiary of his 529 to his brother, okay? I could also change the beneficiary back to me. So what people are wondering is what rules are going to be specified about changing the beneficiary and funding, maybe kind of skirting some of the rules. Again, we don't know any of that yet. But I do think this is a pretty cool, again, the intent, because we've had conversations with some of you about, well, what if you overfund to 529 and your kid gets a full ride? This allows for a way out. Now, it also, I don't think I wrote it here, but it also is capped at a total of $35,000 of lifetime rollovers from the 529 to the Roth. So it's not like this can be, hundreds of thousands of dollars, but it isn't a unique feature, I thought. So that was a lot, but let's break it down into a timeline. Okay, so what you need to know now, and then what's kind of in the future. Here's what you need to know for 2023. The required minimum distribution age is now 73. I didn't mention this yet, but they have reduced the penalty for missing a required distribution. So let's say I was supposed to take $10,000 out of my IRA this year, and I forgot or I didn't do it. Used to be there was a 50% excise tax on a distribution that was not made. It is now reduced to 25%, so a little more palatable. The other 2023, Roth employer matching contributions are permitted, as we discussed. So if I'm contributing to a Roth, I can have my employer contribute their matching to the Roth. Again, if they allow it. One thing to note, those matching contributions, because they're Roth now, they're going to be taxable to you, whereas the pre-tax is not. And it's only going to be useful or allowed in vested matches, right? So if you don't have fully vested matches in your 401k, you're not going to be able to contribute all of those matches to the Roth. One other thing in 2023, it created, some of you might be familiar with the SEP IRA. or a simple IRA designed for small employers. Their retirement plans, like a 401k, but there's small employer plans. It now allows for Roth contributions to be made into those vehicles. So those are some of the main ones in 2023. 2024, that's when employers earning over $145,000 that are making catch-up contributions, that your Roth, they must be Roth catch-up contributions. 2024 is when the 529 to Roth strategy becomes available. And 2024 is when the student loan payments to be treated as elective deferrals are allowed. And then 2025, that's when some of those additional retirement catch-up contributions for ages 60 to 63 are allowed. A couple quick future updates. And look, I'm gonna be right at 45 minutes, I think. A couple quick future updates. There's a lot of dates that are all over the place. There's going to have to be some clarity that comes out through either IRS rulings or whatever it might be around some of these dates and strategies and such. We'll continue to provide information. Again, as we do meetings and strategy sessions with you, we're evaluating what of these make sense, should we make changes, etc. So that's important for you to know. The other future update, again, we're getting closer and closer to the end of the Tax Cut and Job Act. Okay, that was back in 2016. That was the tax laws passed in 2016 that lowered a lot of the rates. I mean, it really changed a lot about the tax code. That was a 10-year period. That all goes away starting January 1st of 2026. And again, unless Congress makes some sort of changes, which is possible, who knows? But if not, we're going to have higher tax rates. They're going to be much more unfavorable. The standard deduction goes way down again. And then the estate tax exemption goes way down again. So those are some things that they're really on in our sights as we try to plan, okay, because we're in a pretty good, relatively speaking, tax code at the moment. And so that goes into a lot of our decision making as well.